Hi, it's Dave here, CEO and founder of the Freedom Founders Mastermind community. Remember, nothing I give to you is financial, legal, investment, or tax advice, but here are my thoughts. We are on the road to disinflation right now. Yes, in the last year and a half, the Federal Reserve has been fighting hard against the high inflationary costs that we've seen coming out of the pandemic. Everything price-wise has gone up. And in terms of our lifestyle, our utilities, our food, our gas, everything that we buy right now, they're still at an all-time high, over 40-year high. The Federal Reserve has been raising interest rates, continues to do so at an attempt to reduce demand, which then would reduce the consumption and start to bring prices down. Well, we're starting to see that start to taper off a little bit. We're seeing some reduction in some costs, but there's still plenty that are sky high. But what about assets? What about assets? Assets like the financial markets, Wall Street, stocks, bonds. What about real estate, other tangibles that a lot of people like to invest in, like me? Coming down in value. Now, in the financial market, to me, that's a free-for-all. I don't have any real clarity or ability other than I just wouldn't be there. That's my own personal take. If you're there, do what you want to do. I would personally be out of the financial markets. I don't study it. I don't try to play the games there. To me, it's just a casino. On the real estate side, I do love tangible assets. Tangible assets give me, the retail investor, a lot more ability to be discerning and pick and choose what I invest in. Does it take a little bit more work? Yeah, absolutely it does. But the work is worth it for me to be able to choose asset classes, equities, debts, or I can choose geography, or I can put my money on the sidelines. Gee, goodness sakes, David, isn't that bad during times of inflation? Not necessarily. If you understand the market cycles, which we always go through, market cycles been going on forever, that during a turning of a cycle, there's going to be corrections. It's like a forest fire coming through and cleaning out all the underbrush so the big strong trees can grow stronger and not be eaten up by all the underbrush. It's what's happening, what's going to happen right now into 2023, probably into 2024 to some extent. We'll go through this correction. So when do you buy back in? Well, in real estate, there's a lag time. It's a lot easier to stay on front of what's happening in real estate prices and know when the times to go back in. In real estate, I base everything on cash flow. What's the cash flow? What am I getting from my return? What's the downside risk? If I believe in the model, I believe in the asset, I believe in the demand for the asset, which I can choose again because in real estate, I can be very, very discerning in particular, then I'll buy back in. What about using leverage right now? Well, leverage is one of the big benefits, the huge benefits of investing in tangible assets like real estate or businesses. Well, right now may not be a good time to use leverage. Interest rates are up, and the asset prices have not come down yet. Again, there's a lag effect. It could take 12 months, could take 18 months. In the last Great Recession, I saw the downward trend of real estate took over 36 months to hit kind of the valley of those prices. So you can't time it exactly right, but you can certainly have a clue as to when to stay clear and when to go back in. Warning to those who have not been through a market cycle as far as being an investor. Be very, very careful right now. There's a lot of FOMO out there. A lot of people saying you got to get in, but making money hand over fist. And a lot of people have made a lot of money in the last 3, 4, 5, 6, 7, 8 years. Right now is a time to be patient. Patience is a virtue. So hold on, be discerning, and wait for the time to buy back in. Take care, and I'll see you next time.